They're telling you the price of silver is stable. They're telling you the market is functioning normally. But right now, a quiet, undeniable signal is flashing in the physical markets that contradicts everything you're being told. The price on your screen is a mirage, a paper promise that is dangerously disconnected from the metal itself. Most people investing in silver today don't actually own any. They own a digital entry, a derivative, a promise to pay. And when the demand for real, tangible metal meets this mountain of paper claims, the entire illusion is going to collapse. This isn't speculation. It's the simple, undeniable physics of supply and demand. To understand the collapse, you first have to understand the mirage. Paper silver isn't a physical bar you can hold. It's an ETF share, a futures contract, an unallocated account entry at a bank. When you buy a silver ETF, you do not own a specific bar of silver in a vault. You own a share in a trust that supposedly holds silver. There's a crucial, life-altering difference between owning a promise and owning the metal itself. Banks and large institutions have built an incredibly profitable business on this distinction. They sell paper claims to silver, hundreds, even thousands of paper ounces for every single physical ounce that actually exists. They profit from the fees, the trading spreads, the financial engineering. The system runs on massive leverage. It's fragile by design. The entire structure depends on a critical assumption that only a tiny fraction of claimants will ever ask for physical delivery at the same time. This is why most silver investors are exposed in a way they don't comprehend. They look at their brokerage statement and see a position in silver. They see a dollar value, but they don't see the counterparty risk. They don't see the fine print that allows for cash settlement instead of metal delivery. They are betting on the price of silver, but they do not possess the asset. Their wealth is contingent on the solvency and honesty of financial intermediaries. When the system is stressed, the promise can be broken, and the price on the screen can become meaningless because it no longer represents the cost of acquiring the real thing. While the paper market creates the illusion of abundance, the physical reality is one of accelerating scarcity. Industrial demand for silver is consuming the metal at a relentless, unprecedented rate. This isn't about jewelry or collectibles. This is about necessity. Every solar panel, every electric vehicle, every smartphone and computer chip requires silver. It's an essential industrial commodity, and global consumption is soaring. The green energy transition alone is creating a demand shock that the market has never seen before. Solar panel production is exploding, and each panel uses a significant amount of silver paste for its conductive properties. This isn't a cyclical trend. It's a structural long-term shift in global energy infrastructure. At the same time, electronics manufacturing continues to grow, embedding silver into billions of new devices every year. This voracious industrial consumption is colliding with a constrained supply. The above-ground stockpile of silver, the readily available metal sitting in vaults, has been shrinking for years. It's being drawn down to feed this industrial demand. Meanwhile, mining supply is flatlining. New silver mines are incredibly difficult and expensive to bring online. Ore grades are declining, meaning miners have to process more and more rock to produce the same amount of metal. The cost of production is rising steadily. This creates a fundamental mathematical gap. Annual mine production, plus recycling, falls short of annual consumption. The deficit is being filled by drawing down the existing above-ground stocks. But you cannot draw down a finite resource forever. The buffer is getting thinner. The physical market is tightening, silently, while the paper market continues to trade as if there's an infinite supply. This disconnect cannot last. The physical reality of scarcity will eventually break the paper fantasy of plenty. The price on the screen is a lagging indicator, a ghost of a reality that has already changed. History shows us that paper markets and physical markets can disconnect, but they always, eventually, reconnect. The question is never if, but when, and under what conditions. We've seen this play out before in various commodities, but this time, the conditions are uniquely dangerous. The pressure points are everywhere, and they are all tightening at once. Look at the warehouse inventories on exchanges like the COMEX. These are the vaults that are supposed to back the futures contracts. The amount of registered silver, the metal actually available for delivery against those contracts, has been trending downward for a long time. Meanwhile, the number of outstanding paper contracts, the open interest, remains massive. The ratio of paper claims to physical metal available for delivery is at a level that should concern anyone who understands how a delivery default begins. It starts when someone says, "I don't want dollars, I want the metal," and the vault cannot provide it. Adding immense pressure to this fragile system is a new class of buyer, sovereign nations. Central banks, particularly in the East, have become net buyers of gold on a massive scale. This is a strategic move away from dollar-denominated assets. And, while their focus has been gold, the same logic of acquiring tangible, non-fiat assets applies to silver. This is not speculative buying. This is strategic, long-term accumulation for national security. It is a drain on the available physical supply that the paper market simply ignores. At the same time, a quiet exodus is happening among smaller players. Retail investors and smaller institutions are increasingly opting to take delivery of their metal from the exchanges. They are reading the same signals, the industrial demand, the shrinking stocks, and they are deciding that possession is 9/10 of the law. They are converting their paper claims into hard assets. This trend, while still a trickle compared to the paper volume, is a steady drip on an already strained system. It increases the strain on the vaults. Then there is the London Bullion Market Association, the center of the unallocated gold and silver trading world. The LBMA system operates on a fraction of the physical metal that its paper trades represent. It functions on trust and the assumption that net settlements will always be in cash. But when trust erodes and when players start demanding physical settlement en masse, the entire structure is exposed. The ticking clock is the sound of these pressures building simultaneously. Industrial consumption draining the physical supply, sovereign buying removing large bars from the market, and a growing number of investors deciding they want the real thing, not a digital IOU. The system is being pulled from all sides, and the paper price is the last thing to know it. The failure won't be a single event, it will be a cascade. It starts with a delivery default. A holder of a futures contract exercises their right to take delivery of 5,000 ounces of silver. The exchange, acting through its clearinghouse, is obligated to provide it from a registered vault. But if the vaults are low, or if the metal that is there is already earmarked for other obligations, a problem arises. The exchange may have to scour for metal from other sources, paying a premium. Or, in a worst-case scenario, it may be forced to declare a failure to deliver. This is where counterparty risk becomes real. Every paper-silver product, every ETF, every unallocated account is a promise from a bank or a financial institution. You are their creditor. Your asset is their liability. When the physical market seizes up, the institution that sold you that paper silver may not be able to acquire the metal you theoretically own if you or many others ask for it at once. The fine print in these agreements almost always gives them an out. They can settle in cash at a price they determine, which may be far below the true physical market price that emerges during a shortage. The moment of failure is when selling meets I want my metal. In a normal market, most trading is paper against paper. You sell your ETF share to another investor. The underlying metal never moves. The system works because the metal is static. But when a critical mass of participants decides they no longer want the paper promise and instead want the physical metal, the music stops. The sellers of paper cannot find enough metal to deliver, and the price discovery mechanism breaks. The screen price becomes meaningless because it no longer reflects the cost of immediate physical possession. There's a crucial difference between price discovery and physical availability. The paper market discovers a price based on expectations, speculation, and financial flows. The physical market has a price based on the actual real-time balance between those who have metal and those who need it. In a crisis, these two prices can diverge violently. The paper price might be $30 an ounce, but if you walk into a bullion dealer and try to buy a 100-ounce bar, you might be quoted $50 or $60 because the immediate supply simply isn't there. The paper market will eventually have to rocket higher to reflect this new physical reality, but not before causing catastrophic losses for those stuck in paper contracts that can't be fulfilled. The chaos would not be contained to silver. A failure in the silver market would immediately call into question the entire precious metals complex, especially gold. The same paper-based system with the same players and the same structural flaws underpins gold trading. A loss of confidence in one would trigger a panic in the other. Investors would rush to take delivery of any tangible asset they could, exposing the leverage in the entire system. The domino effect would reveal that much of the perceived wealth in the financial system is built on promises that cannot be kept when tested. While the mainstream narrative focuses on the paper price, the real story is in the physical movements that don't make headlines. The smart money isn't waiting for the collapse. It's positioning itself ahead of it. This isn't about speculation. It's about securing supply chains and preserving wealth in a tangible form. Industrial users, the largest consumers of physical silver, are the canary in the coal mine. They don't care about the spot price on a screen. They care about having the metal to build their products. Seeing the writing on the wall, the relentless industrial demand and the tightening supply, they are moving to secure long-term physical supply contracts. They are locking in future deliveries at negotiated prices, insulating themselves from the coming volatility and potential shortages in the open market. Their actions are a direct vote of no confidence in the paper market's ability to reliably provide the physical commodity when needed. At the same time, family offices and sovereign wealth funds are making a strategic shift. They are allocating capital to allocated storage. This is a critical distinction. Allocated storage means you own specific identifiable bars with serial numbers held in a vault on your behalf. It is the antithesis of an unallocated account or an ETF. This move is deliberate. They are removing their wealth from the financial system's counterparty risk and placing it directly into a tangible asset they control. They understand that during a systemic crisis, the first assets to be frozen, rehypothecated, or settled for cash will be the unallocated paper claims. This represents a fundamental mindset shift from a financial silver perspective to an industrial silver reality. The financial mindset asks, what is the price? The industrial mindset asks, can I get the metal? The biggest, most sophisticated players are increasingly adopting the latter. They are avoiding paper derivatives like futures and options, not because they can't profit from them, but because the asymmetric risk is now too great. The potential for a small profit on a paper trade is dwarfed by the risk of a total loss if the market fractures. The significance of this can be seen in the delivery volumes on exchanges like the COMEX. While still a small percentage of the total paper volume, the trend of investors standing for delivery, actually taking the metal out of the exchange vaults, is a persistent drain. Each bar that leaves the vault is a bar that can no longer back 100 paper claims. This quiet exodus is a slow-motion run on the bank, and the smart money is at the front of the line, ensuring they get their metal before the doors close. If you hold your silver in a paper form, you need to understand the specific mechanisms of failure. Your risk is not just a falling price. It's the potential for your investment to simply vanish in a cloud of legal fine print and systemic breakdown. Let's break down exactly where the traps are hidden. Start with ETFs. The mechanism for redeeming shares in a silver ETF is not designed for mass exodus. Large authorized participants can redeem shares for baskets of metal, but this process is cumbersome and limited. In a true panic, the ETF sponsor would be forced to sell the trust's physical silver into a raging bull market to raise cash to pay out redeeming shareholders. You would get the cash price, but you would miss the explosive move in the physical metal. This is the shift from being a speculator to becoming a custodian. The goal is to build a fortress, not place a bet. The foundation of that fortress is understanding the hierarchy of security for physical metal. At the very top is direct personal possession. This means coins or small bars that you hold yourself in a safe or secure location that you control. There is no counterparty. The metal is yours, immune to bank failures, broker defaults, or government freezes. For smaller amounts, this is the ultimate form of security. You have eliminated every layer of risk between you and your asset. For larger holdings, allocated storage is the next best option. But you must understand the critical distinction. Allocated means specific bars, with specific serial numbers, are assigned to you and held in a professional insured vault. This is completely different from unallocated storage, where you are just an unsecured creditor to the vault operator who commingles all metal. With allocated storage, the vault is merely a custodian. The metal is legally yours. The due diligence here is everything. You need to verify the vault's reputation, its insurance, its audit procedures, and its geographical location. Diversifying your storage geographically is a wise precaution against localized political or economic instability. The strategy is to build layers of security, moving your wealth from the fragile world of financial promises into the resilient world of tangible property you actually own. The most dangerous assumption you can make is that you will have a clear signal, a siren that goes off right before the collapse. That signal does not exist. The warnings are here now in the quiet data, the shrinking exchange inventories, the relentless industrial demand, the sovereign buying. Waiting for the paper price to crash is a fundamental misunderstanding of the process. The paper price might not crash until after the physical market has already broken. By then, it will be too late to convert your paper claims into metal at a reasonable price, if you can convert them at all. The relationship is inverse to what most people expect. A sudden, sharp spike in the paper price is often a symptom of the physical shortage finally overwhelming the paper market. It's not the beginning of the opportunity, it's the confirmation that the opportunity to prepare has passed. The time to move is when the physical market is still functioning, when premiums are low, and when you can take deliberate, calm action. The cost of being early is minor, perhaps some storage fees or the opportunity cost of capital. The cost of being late is catastrophic, the potential total loss of your paper investment and the inability to acquire physical metal at any price. This is why a gradual, disciplined accumulation strategy is superior to trying to time a single all-in move. Start converting a portion of your paper exposure to physical metal now. Set a schedule. Every month, take a percentage of your portfolio and move it from the digital realm to the tangible. This dollar-cost averaging approach removes the emotion and the pressure of timing a perfect entry. It acknowledges that you cannot predict the exact moment of failure, but you can recognize the building pressure and act before the dam breaks. The goal is not to catch the bottom tick on a chart. The goal is to ensure that when the paper and physical markets violently reconcile, you are safely on the side of physical reality, owning what cannot be printed or defaulted on. The calm confidence that comes from this position is the real wealth, long before any price appreciation occurs. This entire situation is managed through a constant, deliberate psychological campaign. Why does the mainstream media ignore the undeniable physical shortage? Because the narrative is not designed to inform you, it's designed to manage you. The stability of the entire paper-based financial system depends on confidence. The moment a critical mass of people understands that the price on the screen is a fiction, the game is over. So, the narrative must be that silver is a barbarous relic, a volatile industrial metal with no monetary role. It must be portrayed as a speculative toy, not a fundamental store of value. The price suppression narrative is a key part of this. You'll hear experts talk about large short positions or manipulation as if it's a temporary distortion. This framing is itself a form of control. It makes the problem seem like a technical glitch that can be fixed. rather than a systemic feature. It keeps people focused on the paper price, waiting for a squeeze that may never come in the form they expect, while the real opportunity, the physical metal, slips away. The goal is to make you doubt the evidence of your own eyes, to make you think that the shrinking inventories and soaring industrial demand are irrelevant because the market price says otherwise. Maintaining your conviction in the face of this requires a specific discipline. It means learning to ignore the daily noise of paper price fluctuations. Your focus must shift from the portfolio value on a screen to the number of ounces you own. The paper price is a distraction, a tool used to trigger emotional reactions. Fear when it drops, greed when it rises. But if you are accumulating physical metal, a lower paper price is a gift, a chance to acquire more real wealth for the same amount of depreciating currency. The psychological shift is from being a passive spectator of a digital number to being an active custodian of a tangible asset. Your confidence comes not from the market's daily opinion, but from the silent, undeniable reality of the metal in your possession. This is the real warfare, a battle for your perception, fought with the goal of keeping you invested in a system that is fundamentally designed to fail you. A collapse in the paper-silver market is not an isolated event. It is a symptom, a crack that reveals the deeper structural flaws in the entire global financial system. The paper-silver market is a microcosm of a much larger problem, the proliferation of financial claims that far exceed the underlying tangible assets. This is a system built on confidence in fiat currency and the institutions that create it. When that confidence is shattered in one corner of the market, it calls into question the entire foundation. The connection to dollar dominance is direct. The US dollar's status as the world's reserve currency is what allows for this massive creation of dollar-denominated paper claims. But this system is predicated on an endless expansion of debt. Silver and gold represent the antithesis of this system. They are money that cannot be created by decree. A failure of the paper precious metals market would be a dramatic, undeniable signal that the world is losing faith in the ability of paper promises to hold value. It would be a vote for something real, something that has served as money for thousands of years, over something that can be printed into oblivion. This is why the interaction between gold and silver during systemic stress is so critical. Gold is the primary monetary metal, the ultimate store of value for central banks and large institutions. Silver is gold's more volatile industrial sibling. In a true systemic crisis, a break in the silver market would act as a tripwire for gold. The same forces that exposed the paper-silver market, the demand for physical delivery, would immediately migrate to gold. The two metals are linked not just by tradition, but by the shared vulnerability of their paper trading systems. A crisis in one would inevitably trigger a crisis of confidence in the other, accelerating the flight from paper assets to tangible ones. This pattern of monetary resets is not new. It's a recurring feature of financial history. When a debt-based system becomes unsustainable, when confidence in the currency evaporates, a reset occurs. The existing system is replaced, and a new monetary foundation is established. Historically, that new foundation has almost always been anchored to a tangible asset, most often gold. The current system is no different. Its inherent contradictions are becoming impossible to ignore. The unsustainable debt levels, the rampant money printing, the erosion of purchasing power, these are all signs of a system in its terminal phase. What a silver collapse reveals is the path forward. It demonstrates in real time that tangible assets become the only viable foundation for wealth when the financial system loses credibility. It shows that real value cannot be conjured from nothing. It must be dug from the ground, manufactured into useful products, and held in a form that is immune to default. The strategic advantage lies in recognizing this pattern before the reset is forced upon everyone. Moving your wealth from paper claims to physical assets is not merely an investment strategy. It is a vote for a different system, one based on reality rather than promises. It is the first step in positioning yourself not just to survive the coming transition, but to emerge with your wealth and your freedom intact. The calm that comes from this position is the ultimate advantage, the quiet confidence of owning what cannot be printed, defaulted on, or erased by a keystroke. This is the final shift, the psychological transformation from being a speculator to becoming a custodian. When you hold physical silver, your time horizon changes. You're no longer watching a screen, reacting to noise. You're building a foundation that transcends financial cycles. This ownership brings a profound freedom. Freedom from counterparty risk, from system dependency, from the fear that your wealth is just a digital entry that can be frozen or vanished. You are not betting on a price. You are owning value. You are building a legacy anchored in something real, something that has preserved wealth for centuries. This quiet confidence is the ultimate wealth long before any price appreciation occurs. The paper and physical markets will inevitably reconcile. The asymmetric risk is clear. The cost of being wrong is minimal, but the cost of being unprepared is everything. The action is simple. Convert your paper claims into physical metal. Own what cannot be printed. The calm that comes from this tangible security is the strategic advantage. Move before the crowd understands what's happening.